Hi, I'm Ashley with Campbell. Thanks for investing your time to help your community be a great place to live. Before you watch the video, make sure to click the subscribe button so that we can help you make educated decisions as a board member.
So I'd like now just to make a brief introduction of Bill, a little bit about Bill. He is a member of the National Association of Enrolled Agents. He is also a member of the Florida Institute of Certified Public Accounting, FICPA. He's on the State Tax Committee and the CIRA Committee. I've run into Bill myself in Tallahassee on more than one occasion advocating for our community associations, and he's got 35 years of public accounting experience.
Thank you, Beth, and thanks, Ashley. Good afternoon, everyone. As they said, my name is Bill, and I'm here to answer all your questions. I think that over the years, the biggest question that I get on the tax side when I hand them the return is, hey, how come this doesn't agree to the financial statements? And so today I thought that we'd start with a little bit of a geography lesson on the income statement and balance sheet before I get into a little more of the nitty gritty. This way, you get a feel for the presentation. It's a little bit different for those people that might be CFOs out there because the financial statements aren't put together and not presented like the GAAP financial statements are for SEC purposes. It's really under fund accounting. And so it's a little bit different in terms of the presentation. I know when I get down, yes.
I'm just going to go through just very quickly the brief outline. So we've got an important disclaimer. We're going to talk about the financial statements, different types of accounting, reserve and special assessment funding, the importance of footnotes, the levels of audit services, recent changes, and legislative changes. On the next slide, we have an important disclaimer for everybody. You can read it on your own. It basically just says that this webinar is for discussion purposes and does not constitute professional advice customized for your association. On the next slide, so this is a very basic statement of revenue and expenses that Bill is going to talk about. And I just want to share for a minute. In our audience today, we've got 59% condos, 38% HOAs, and 3% co-op. So thanks everybody for attending. And we're going to try to address each audience as best as possible in the time allotted. Okay, Bill, thank you.
Okay, thanks, Beth. That's great that we have such a great turnout in terms of the condos and the HOAs, because they're the most similar out of the three. The housing cooperative is a little bit different in the way that it's presented and the ownership structure. So, but we'll get into that and I'll make sure that I touch base. So the first thing that I wanted to go over with you is this, they call the income statement under fund accounting a statement of revenue and expenses. So I thought I'd give everyone a little bit of an overview as to how to really understand it and read it. And now's a great time because I know that all the associations that are calendar year are in the throes of doing their budgets and finalizing their budgets. And so hopefully this will help when the board gets to look at, the preliminary budget and or the financials for the year. It'll give them a little bit better idea as to how to navigate through them. So basically what happens is that this template that I've got here now is a client that we had. And in every association, whether it be a condo or an HOA or even a co-op, a housing co-op, you're going to have basically three columns. You're going to have an operating fund column, a replacement fund column, and a total column. Here in this particular case, we have a capital project fund as a separate column because this was a special project that the association undertook to create a restaurant and a bar, and it was separately funded from what your typical replacement fund is. So they decided that they wanted to break it out for the reader, and that's why we've got a third column in here called Capital Project Fund. So the first column that you're going to focus on is always going to be the operating column, because that's the column that drives the association. It's the revenues that they take in, plus the expenses that they incur for the maintenance and repair for the year for the property. So if it's an HOA, it's likely, the landscaping that goes on outside, along with maybe perhaps the painting of the homes and the like. If you're in a condo, it's obviously, the hallways and stairwells and, the common area within a condominium. So for example, when we talk about the first line, which is the assessments in the operating fund, that is the amounts that they totaled up for your quarterly assessments for maintenance and the like. So that's that 5,293,000 number that you see there. Now, in this particular situation, the association decided that they wanted to bring in some extra revenue for charging it basically an exit fee if somebody was going to be selling their property. And so you'll see that they charged resale fees totaling $255,000, and they created docs that basically told you what piece of it was going to be available to increase the operating fund and what was going to go against the capital project fund. So that's why it's split up. The next item that you're going to see, and hopefully you'll see big numbers now that the reserves are starting to build up, is the interest in investment income. And you'll see that the operating fund generated basically $96,000 worth of interest in investment income, and in the replacement fund it was $83,000. So collectively it was fairly healthy. We're talking about $179,000 there. Then the next item that they collect outside of the quarterly maintenance is they collect boat slip storage income. This particular association has docks. They rent those docks out, and then they've got another line item called other income. And typically that's like key fob income. It might be some rental of bicycles or kayaks, or it might be income from an event. So that's what the other income is. So the total that they're taking in terms of the operating fund is $5.7 million. And those related expenses that are down below that are directly related to operating, which means that it's that current year, it's maintenance and repair, it's the overhead for the management company or the people that are managing the property, the salaries and benefits and the like. So in this particular case, by looking at this, we see that they've got an excess of expenses over revenue, which puts them basically in a deficit. So obviously, as they get into their budgeting for the next year, they're going to have to see, how they're going to fund that and fix that that particular situation of having a deficit of 447. But we're going to hold that in abeyance for a moment, and we're just going to talk about, if I prepared the tax return, my starting point is always going to be the operating column, because any assessment that goes in, whether it's a special assessment to the capital fund or it's the quarterly assessment to fund the reserves, those amounts are not subject to tax. Why? Because when the IRS established the rules around associations back in 1976, the whole mindset was to basically have the owners pay into an association who will then turn around and use their money to cover the expenses of their homes and the common area property there. It was really only the intention to basically tax whatever came outside of that came from a third party. So for example, in this particular case, we're talking about the interest in the investment income. Even though it was income earned on the investments that they contributed by funding, it's still subject to tax. The IRS doesn't give everything away for free.
And
So
Bill,
if
we have
you
a
pick,
few questions when you have a second.
Sure, go ahead.
Okay. One of the questions is, what does the replacement column represent?
The replacement column is for those items that are future capital expenditures. So for example, if you're a condominium, it's the future cost to replace the roof, or it might be for concrete work, or it might be for paving in the parking lot. And so typically what happens is the association will engage to have a reserve study for these future capital expenditures. And what will happen is a professional will come in and they'll determine what the remaining life is and what the expected costs are, so that at the end of the day, they could have them funded for when those projects come to bear. So that's the replacement fund. As I said, the capital project fund is a little bit different because the association voted to build this, and it's a project of construction. And so therefore, it's usually a special assessment, and it's aside from the actual reserve study that gets taken place. Okay.
Thank you. And we have another question. My condo's financials look nothing like this. They are just one column.
That might be a situation. Well, it may be a situation because of the type of report that you're getting. If you're only getting a compilation, or you don't reserve for future capital expenditures, then you might most likely would only have one column. I would need to understand whether or not you have reserves. In some cases, the associations that are smaller may decide to wait until that point in time to actually put aside money or assess for those. But chances are it might be a compilation, and a compilation doesn't require a full-blown set of financials like this. These financials that you're looking at now are the top end of the financials. There's 3 levels of audit: an audit, a review, and a compilation. The compilation is the lowest. We're going to get into that. That's possibly why we have a different set of financials for this particular person, but we'll get into more of that as we go on.
And can you discuss replacements versus reserves?
Well, they call it a replacement fund, but the replacement fund is really a reserve that you're building up to pay for those future capital expenditures, to fix the roof or repair the roof or replace the roof, or to do the concrete work, or to do something capital in nature. Typically, they define a capital expenditure to be something that's over $10,000, and it doesn't go to put something that's broken back in repair. It's an actual replacement.
Okay. And then where in the statement will you see the fund carryover from the previous year?
The what carryover?
The fund.
Oh, the funds, well, we're going to see that on the balance sheet, which is the next statement. This is only the income and the expenses. We can jump into the balance sheet and go through that.
Okay, why don't we move forward to the balance sheet?
Sure.
And again, we're happy to answer any questions after the event. You're going to receive the presentation and the audio and contact details to send your questions.
Right. So the great thing to look at here is that at the end of this period, you can actually see the remaining amount that they have in the replacement fund. When you look at the top, they basically have collected $2,031,000, and they've actually paid out $32,700, but they've got what they've called as deferred maintenance and capital expenditures, and we're going to hold that in abeyance because I have an example of that on the slide behind. But basically what you're going to see is you're going to see that if you look down at the bottom, the fund balance in that capital project fund for both of them is $2,163,000. And so that will be the balances that are in there. Remember now, when you're looking at the reserves at the top in the assets section, you're looking at the amounts that are actually either in a cash bank account, in a certificate of deposit, or in the investments. Okay. The offsetting bottom where you see the liability section is going to be the pieces that are related to those special project funds. If you look in the capital project fund column, for example, you're going to see that they took on long-term debt of $17 million. So they've got a property and equipment that they paid in and capitalized for that beach and restaurant project, but they've got an offsetting liability that they're paying down, and that's the balance of what the debt is. So we can jump forward now. I think that from a geography standpoint, we're good. So I started to answer the question that we've got in this first statement. Why is the income and the loss on the tax return different from the financial statement? As we saw, you had an operating deficit of approximately 447,000. Well, if you're going to start to do the tax return, you've got to make sure that you go and you look at the interest that's on the reserve side, because that is subject to tax. And if you go up and you look, you'll see that it's $83,000. So the starting point for the tax return is not going to be the 447 loss. It is going to be 447 less the 83,000. And so that's going to be the starting point. Typically, when I have someone on the board that looks at it and they look at the statement that we just went over and they looked at the tax return, it's like, hey, is this the right tax return? Believe me, it is. So one of the things that I didn't talk about on that other slide is the reserve columns. And one of the things that the IRS wanted to also make sure back in the day is that if you're also contributing for future capital expenditures, those amounts are not going to be subject to tax. And so what happens is it goes in as a non-taxable item. Even though you're reporting it on those financials. To the extent that you've got the ensuing expenditures, it's obviously going to take down the balance. But at no point, except for, because everything's an except for in tax, there's a couple of items that don't qualify as capital expenditures that are within that statement. And that's something that we need to consider. And I'm going to go over that in about a half a minute. The next question that I get very, very often is, hey, we looked up, our association is a not-for-profit. Why are we paying tax? Well, non-for-profit under SunBiz only means that you're not intending to pay dividends and that the entity is not expected to turn a profit. So it really meets and matches what an association starts up for, because they're not looking to make a profit and charge the owners more than what the maintenance is. They're looking to break even. And so the second thing that they wanted to make sure is if it did set up like that, that there wouldn't be any dividends paid out to the owners in terms of returning that to them. So not-for-profit simply means that you still have to file a tax return for them. The capital columns won't be subject to tax except for a few, which I'm going to get into. And it's going to be a situation where you're going to basically be reporting that income that we talked about that is outside of the collection of the quarterly maintenance, whether it be the quarterly maintenance amount or the quarterly funding for the replacement reserves. Any monies that are received outside of that, such as the interest in this event income, is all going to be subject to tax. But the good news is there's some expenses that are going to go against that are going to be able to offset that. And so we'll talk a little bit about that as we get into it a little bit more.
And before we, I just have a few questions that have come in. If you have a surplus 1 year, but use it to offset the next year's assessment or maintenance, is the surplus taxable?
That's a great question, and that's in the back slide, but I'll give you the quick and dirty, the quick and down dirty under answer right now. Generally not. And I'm going to explain to you there's some tax advantages that you can take that would preclude you from having to pick that up. And the big thing is basically if you're going to file an 1120H return, it doesn't matter that your association has collected revenue in excess of your expenses, because it won't be subject to tax at all if you're filing that way. Or alternatively, there's a mechanism in place where the community can vote if they've got a situation where they think they're going to have a surplus in the operating. They can actually do one of two things. They can vote to have that returned to the owners, or they can use those excess funds to reduce next year's budgeted amounts.
Okay.
And that will preclude them from paying tax.
Thank you, Bill. Next question. Are insurance payouts for a covered claim, for example, storm damage, a taxable expense to the condo association?
Typically, no.
All righty. And can the interest from CDs and money markets be used to allocate towards roof reserve?
Typically what happens is the associations do look at the monies that they have in the accounts, and to the extent that the incomes are in separate bank accounts is normally how they allocate that interest to the reserves or into the operating. But it doesn't matter, as I said, in either case, because whether it's in the operating or it's in the reserve column, the interest is subject to tax.
Okay. And how is revenue supposed to be handled? I think this might relate to that Form 1120. At the end of the year, is revenue supposed to be moved to equity or reserves?
Yeah, typically, well, first of all, you can't take that excess and bring it over from a tax perspective. Typically what happens is that depending on how the association decides they want to handle, you know, an overage or an underage, is going to affect obviously the reserve columns ultimately, but it can't affect it for tax purposes.
Okay, and then we have a budget question, as it is budget season. Does the board have to hold a public budget workshop to vote on the draft budget and then hold another owners meeting to address owners' questions? My board usually does it all in one meeting.
The budgets are, they do get complicated. If you're a condominium, you know, you've got to present the initial budget as being fully funded, and over the years, they voted to fund it less than what the fully funding is, and there's a myriad of different situations. I can speak to that budgeting end of it in a session that'll go at least an hour. So
okay, perfect.
I can table that and give them a deeper answer if they want to email me at the end.
Perfect. Okay, moving on to the next slide.
Okay, so I'm going to dive a little bit more into the tax return filing, because this is kind of important now, especially at this time. So if you're a condominium or an HOA, you can file either a Form 1120 or 1120H. And as I was just talking about, probably 95% of the associations file the 1120H simply because they don't have a situation where they're going to necessarily pay tax on an excess of revenue over expenses. So you don't have to prepare yourself for anything. You just have to make sure that you qualify. And so the filing of the 1120H is an election that's made by actually filing the return. So one year you could decide that you want to file the 1120 for tax planning purposes. The next year you could go back to filing the 1120H. But typically, if you qualify, because there's two big qualifications in order to be able to file the 1120H. First qualification is that not more than 40% of the total income that you receive or revenue that you receive cannot come from outside sources, okay? Because that'll preclude you from filing that. The second thing is there's an expense limitation. You can then file if you had, say, 35%, but you're limited to offset expenses by 10% of the total expenses that the association incurred. So there might be a case where if you've got a significant amount of money in terms of coming from, you know, third parties, you might end up having to pay tax, and that's at 30%. You do have some options. Instead of filing the 1120H, you can file an 1120. We can talk about that for a second as well, too. So filing the 1120 is basically filing a normal corporate tax return for all intent and purposes. However, what happens is whether you file an 1120H, you file an 1120, or you file an 1120C for the housing co-ops, you have to parse out the income that is coming from third parties, not from the quarterly assessments that you pay. That's going to be subject to tax. So you've got to identify that and split that. What they let you do, however, is on the 1120, they call it member, non-member income. On the 1120H, it's exempt function and non-exempt function income. And on the housing co-op, it's called patronage and non-patronage income. Remember, simply, it's either member or non-member. Put that in your memory banks. So you're parsing that out, you're reporting that income that's outside of the quarterly assessments, and you're calculating the expenses, both direct and indirect, that could go to offset that. So as I said, one of the pitfalls of doing the 1120H is that the tax rate right now is 30%. The good news is you don't have to pay a Florida corporate tax return, nor do you have to file it. The bad news is that if you decide you're going to file the 1120, you end up having to file a corporate Florida tax return no matter what, even if you're not subject to the tax. But because of the difference in the rates right now, you really do have to take a close look if you're subject to tax, simply because of the fact that, remember, you're going to pay a 30% tax if you file the 1120H, and you're going to pay an effective rate of only 25% if you file the 1120, because now, as everyone knows, the corporate tax rate is only down to 21%. So the difference between the 21% federal and that 5.5% Florida corporate surtax, that's how you get that 25%. So you need to take a look at it as you get into, your budget season. Where am I going to be at? What do I need to do? The final pitfall to the whole thing as well is that at the end of the day, you're going to need to figure out whether you need to pay in, because what happens is if you decide that you're going to owe money and you're going to file the 1120, then you're probably going to get hit with some interest and penalties for not paying quarterly. The great thing, once again, with doing the 1120H is the tax isn't due quarterly, it's due at the date of the return. So you've got to figure that all into play as you decide whether you're going to do the 1120H or not. The 1120C, it's going to fall under the same parameters as if you filed the 1120. You've got to do the federal and you've got to do the Florida. There's no way to get away from that. One of the other things that is really important that you look at, and you're probably only going to get this when you get the audit level, is related notes to the financial statements. I really think that that's important, because it gives you the opportunity to look at an analysis of the future major repairs and replacements. So typically what will happen is, as I said before, if you get engaged in a reserve study, there'll be a note or a section in there that'll explain how they came about, what each of the categories are, whether it be roofing or concrete or paving, what the cost is right now, and what the number of years remaining before it's got to be replaced. So that's important because it's going to give you the information that you need to determine, hey, what do I need to do to fund this? Are you going to fully fund it, partially fund it? Very important questions that occur as obviously you're doing the budget, because you're also preparing for next year's piece of the quarterly assessments for the reserves. The next thing is the statement of revenue and expenses on the operating fund side. Why is that good? It's good because it gives you a comparison by expense category of what it was this year versus last year. So for example, if you were a board member and you were present last year, you would have had to buckle into your chair when you saw what the insurance premiums went from to what they are now, and figure out, how you're going to pay for them. So that's why that's also an important schedule to be able to look at, to ascertain, hey, listen, what's up, what's down? Do we understand why? Was it a once-off, or is it some sort of trend? So I think we can jump to the next one. Okay, so I do want to just kind of end a little bit about, this fund versus GAAP presentation. So GAAP stands for Generally Accepted Accounting Principles. And so, as I said when I first started, it's a little bit of a difference. I mean, I came from a world in New York where, you know, I was with the Big Four, and, you know, we only did SEC companies. So, you know, when I came down here to Florida and I picked up, you know, associations, you know, it was kind of fund accounting. I had to retrain myself a little bit. But it's interesting because I see some of the pluses and minuses. So we already kind of touched on the fact that a Florida not-for-profit doesn't mean that, you know, you're tax exempt. And, you know, the business focus for regular GAAP financial state reporting is just focusing on the entity's operating income and the expenses. It's not really looking to, you know, get into what you put aside for the reserves or a capital project fund. It's just really looking at the income and the expenses there. But fund accounting is different because, as I'm saying here in the slide, it's specialized. And what you're looking at is you're looking at how the association has decided to direct funds between what's in operating, what's in replacement, and possibly even the capital projects fund. So that's what makes it a little bit different and a little bit special, because it's broken out that way. You know, you're operating a business, yes, but it's not a business that's for profit. One thing that I just learned not that I didn't know it, but what I experienced this past year is under GAAP, and this is really important because if you go back to the revenue statement that I got here, they're showing $179,000 worth of book income. And what happens is that there's some nuances to reporting under fund versus under GAAP financials. And the biggest thing to hit the associations is this unrealized gains or losses. So let me kind of talk in English here because, you know, this is one of these things where it's like, wow. So I had this client that happened to be this income statement that we had that had $179,000 worth of income. And I was like, wow, they're going to be paying, you know, some big tax. So it was on the investments. They gave me the Morgan Stanley statements. And so as I go through the statements, you know, they basically have the interest and dividends that they paid out. They've got realized gains and they've got unrealized. So basically, when you amalgamate all them together, that's really the change in what their investment is, okay? It includes all of that. But in this particular case, there was like $50,000 or $60,000 worth of unrealized gains. And that goes into the statement of revenues. Unrealized gains, although they've been talking lately about wanting to tax unrealized gains, we're not there yet. The unrealized gains should really be pulled out of there. And if you weren't aware that fund accounting didn't have that ability to put it somewhere else, which I'm going to tell you in a minute, on the balance sheet, and you didn't look closely, you might be paying tax on unrealized gains and losses. So it's important that if you're whether you're an association, a condo, an HOA, or a housing co-op, the rules are the same. If you've got investments which are usually kind of a no-no in the association world, look on your statements. The second thing that you're going to want to look at is buried in that statement is the advisory fees. Make sure you pick that up as a directly related expense as well, because that should go against it. Once again, when they give you what your change in your balance is, it's all those components. So very important thing to know. Now, what happens if you're filing GAAP financials? Well, what happens is the reader of the financials on GAAP financials, they put them into what they call other comprehensive income. And that other comprehensive income really isn't comprehensive income, so to speak. It's these unrealized gains from the sales of stock and the like. And it's also unrealized translation gain. So if you had a US company that owned a foreign subsidiary that was basically being maintained in local currency, when you translate to US dollars because you're going to consolidate, there's going to be an FX difference between the income or loss and the end of the month balance sheet rate. And so that difference in calculating what that FX exchange is goes to OCI along with the unrealized gains, and it's detailed out. But like I said, OCI isn't a component of fund accounting. So just a fun fact that I decided to throw in. Okay.
Thank you, Bill. And we've got just a few minutes left to go through the remaining slides. So we're going to try to pick it up a little bit.
Okay.
And we do have questions that are waiting to be answered.
Okay, so the only other thing that I want to talk about down here is the FDIC insurance, Beth, on the CDs, because one of the requirements is that the reserve fund and the capital projects fund, those amounts need to be put into separate bank accounts and cannot be commingled with the operating account. That's number one. And number two is, you know, with associations that have more than $250,000, there's a possibility that they might decide to put it into one bank account and they won't be covered by that $250,000 FDIC. So what typically happens in that particular case is you can go back to your management company, for example, and ask them about the different CEDARS programs and ICS funds that allow you to maintain FDIC coverage in excess of that 250. So that's important for everyone to know. And if you are being audited and you don't do it, chances are when you receive your audit, you're going to need to get that fixed pretty quick. Okay.
And that's something your management company as well as your accountant should definitely be providing guidance on.
Yeah. Yeah. The best practice on that would be to go back to your management company, because they can point you to the financial institutions that have these CDARS and ICS availability programs so that you can go in and make sure that you move it. Okay. Next slide.
Okay, so the next slide.
This is the last big slide that I want to hit home on. Okay, and then we're going to skim through the audit. One of the big things is that I get pushback on is, oh, you CPAs just want to do audits because, you know, you get more money from that versus a compilation. Well, that's not really the case. Today in this environment, and especially now, even at the association level, as it was back in the day with SEC companies, is they want to make sure that the reader of the financial statements can be an average Joe and that they can pick it up and read it. Okay. What happens is when you undertake a cash basis, it's terrible because a reader picking up the financials has no idea what the potential is for the statement being wrong. So I'm going to go out on a limb here. So let me give you an example, just two quick ones. So if you were on a cash basis, that means that you don't report any monies coming in until you actually receive it, nor do you record any expenses until you've actually paid by check or cash, okay? So that means that activities that you've decided to put off in a period isn't going to be put onto a general ledger. And that means if it doesn't get to the general ledger, somebody picking up those financials aren't necessarily going to be in a situation where they're going to know the truth. So this example that I'm talking about, you've got quarterly assessments. When you have a cash basis and someone hasn't paid, they haven't recorded the revenue because they haven't received the cash. So now you get the financial statements, and how do you know? Is it 1? Is it 10? Is it 20? Did anybody not pay? Where am I at? And that's a bad thing. The other side of it is, say you're in the last week of the year, and something goes wrong in the community pool, and you need to get the pool pump replaced. So you send somebody in, the vendor gives you an invoice, and you don't get to pay that invoice until next year. Well, now you got an expense that you incurred in one period, but it's being paid in another. Once again, it's going to skew the results for the reader. So in the case of the situation where you've got a quarterly assessment, if you're following the accrual basis, it's beautiful because you're going to see as a reader that, yeah, there's an outstanding accounts receivable. You're going to be able to look into the books and records as to when that receivable came on the books and what the aging is. Is it 30 days, 60 days, 90, 120? How many people didn't pay in? What's the dollar amount? How is it going to impact my financials from a cash flow perspective if I've got 10 people that haven't paid in? What am I going to do? The same with an expense. If you incurred that expense, if you don't set that up as an accrued expense, then it's not going to be showing up on your financials at the right time. And that's why it's important, in my estimation, that the financials be done on an accrual basis. Compilation, sometimes people say, I'll just take a compilation and, we'll do it on the cash basis. I don't recommend that, okay? And especially under today. So let's go onto the slides now for the 3 levels of, I think I talked about the special assessment funding, so we can skip that.
I think you covered that, yes.
Yeah.
And the footnote.
We talked about the footnote to the financial statements, so we can skip this one. Compilation. Okay, so there's 3 levels of audit services. Okay, I gotta get my hat out here because I forget what the amounts are. Okay, I've got it now. So what's the requirement? Well, if you're over $500,000 in revenue, you're required to have an audit. So the audit's the highest level of the financial statements services that a CPA can provide. The next level down is anybody that's collecting 300 to 500 is a review, and I'm going to get into the difference between the review and the audit. And the last level, which is kind of next to the lowest, is called a compilation. What do I like about a compilation? Well, once again, because it isn't an audit, it doesn't have to be on an accrual basis, so technically it could be on cash. And all it is the accounting firm taking the information from your general ledger and putting it into the format that I showed you on the statement of revenues and expenses and on the balance sheet. That's all it's doing. It's extracting it. It's not looking to compare this year's balance to last year's balance. It's not looking to, create a series of footnotes. In a lot of cases, it's just basically an income statement and maybe a balance sheet. And it's taking it from, the books and records. So,
and Bill, can you touch on who is qualified to provide each level of service?
Well, on the compilation, it doesn't necessarily need to be a CPA because it's not an audit. So we're really only talking about the audits and the reviews that the CPA firm would perform. So, you can have your bookkeeper basically, if they know how to do the compilation and how to put it into the proper format, can take the information that they've done in their report and put it into the format that's basically acceptable for an association. What's the difference between a review and an audit? Well, let's talk about the audit first. We test, we review procedures and controls on financial reporting. We take risk assessment before we even start the audit to see where the areas of risk are and plan the audit to identify those. We identify areas when planning the audit so that we can, possibly turn that over. We look at the check processing and sign off. We look at the access, for example, to the general ledger software, who has the ability to go in. We look at the interaction between the board of directors and the community and or the association, the management company, and make sure that there's processes in place and controls to ensure the integrity of the process and reporting for the financial statements. So the review is a limited insurance. It's not that testing. It's not that risk plan. It's basically a level down from your full-blown audit. As I said, over 500,000 requires an audit. Now, one other important fact for people that are in HOAs. They just signed a bill actually in July that was effective July 1st, and HOAs can no longer defer the audit if they're required to down to a compilation. You're not allowed to do that on any consecutive years now. So that means if you were last year on a compilation, no way. It's going to be an audit going forward. So very important. And then the final is that there's one other level, less than $150,000, which is a very small HOA, just requires a report of cash receipts and disbursement. So it doesn't even require the formatting that you get in a compilation. Okay. I think the only thing that I did want to talk about was two quick things. One of the other things that passed through on the HOA as well is debit cards. And so Florida Statute 720, which is the one that regulates the homeowners associations, now prohibits an HOA and its officers, directors, employees, and agents from using a debit card issued in the HOA's name or billed directly to the HOA for the payment of any association expenses. Anyone violating this commits theft as provided under Florida Statute 812.014. Okay. And then the second thing, or third thing, second and third, is now an association needs to maintain, an HOA needs to maintain records for 7 years, and it requires HOA to provide a physical or digital copy of their rules and covenants to each owner forever and forever now. So with that, we have a couple of minutes, so if you want to.
Okay, this is going to be like a rapid fire question and answer session, Bill. What about credit cards for condos? Are those okay?
They've taken down, well, actually, no. They've taken down the ability on the credit cards as well, specifically under 718 for the condo. So HOA is just catching up now.
Okay, very good. And can associations use a credit card to pay recurring bills like office supplies, monthly lawn service, and things like that?
Nope.
Thank you. Let's see. Just going through. Does revenue include assessments for reserve funds or just the assessments for operating expenses?
No, it's a revenue for both replacement and capital funds as well as the operating fund as well.
All right. Instead of FDIC banks, can you use a brokerage firm to buy U.S. Treasuries?
Yes, you can, but once again, I think that you got to look and see what that yield is going to be and compare that to to what you're getting with the CDs. I mean, the treasuries are going to be subject to tax. It's not like they're tax exempt.
Okay. And can HOAs invest reserve money into tax exempt municipal money market funds?
Yeah, they can. I guess if their docs say they can, and basically everyone is in agreement. Once again, I mean, you could have a situation where something happens and you don't get the money, and that's not a good thing.
That's right. There's cities that have gone bankrupt.
Yeah. Well, there was
Okay.
a couple of years ago, the big one was Puerto Rico. Everybody
Yes.
was buying for the Puerto Rico stuff, and that went down the tubes.
Yes. Does somebody have to have a CPA credential to perform an audit?
Yes.
And what if they don't? Is it possible they're operating under somebody else's license? How does that work?
Yeah, you have a firm can have people in the firm that might be first or second year staff and or seniors, and so they're doing segments of the audit, but it comes under review and sign off by the CPA.
Okay. And we've got a co-op question. A co-op association received a vendor rebate for a vendor appreciation for $30,000. If they put that vendor rebate in reserves, will they have to pay taxes on it?
If you're going to label it for future capital expenditures, the answer to that question would be no. But here's the thing. I mean, I actually, if you go to I don't know if it's the next one or the one after, we talk about capital contributions. And one of the things that we talk about that is a requirement for it to be capital contribution, because from the tax side, you do need to perfect what you're using it for. And you've got to basically make sure that it's not commingled with the operating funds, and it's basically used it doesn't have to be used within a certain point in time, but it's got to be for a future capital expenditure. It can't go back into the operating, to satisfy a deficit.
Very good. And are estoppel fees and late fees taxable?
The late fees, yeah, are taxable, and the estoppel as well too.
Okay, and if there are excess funds from an insurance claim, are those excess funds taxable?
Yeah, I'd need to know, if the excess funds are because of punitive damages, my guess would be, because everything is fact specific, my guess would be it would be. But if it turns out that, it's going to, in effect, reinstate the capital asset, then, generally speaking, no.
Okay. And then I've got a developer turnover question. If the developer has 90 days after turnover to provide audited statements, but then does not meet that deadline, then what happens?
That's a good question. I think that they would probably need to contact their association attorneys to see what, if any, legal steps they could take. I'm assuming that if they don't meet it in the statutory time frame, the association would probably go to the DBPR.
Okay. And for condominiums, can an audit be waived in non-consecutive years?
Yeah. Yes.
All righty. We got a request for a comprehensive class to be held on HOA condo credit and debit card law and usage. I agree. I think anything that has penalties should have an explanation attached to it.
Yeah, if you go into 720, Beth, yes. You can see, and I could probably give them the sites. I think I've copied everything right off of the statute, which I can forward if people are interested in it. That goes to all of the changes to the HOA under 720. But I really certainly suggest that you reach out to your law firm that's there too as well, because they can help make sure that you implement what you need to.
Yes, absolutely. And should income like boat slip fees be distributed proportionally to all owners? How should those types of income be assessed? I think part of it would definitely depend on your governing documents. So that would be an association attorney question. But Bill, do you see any tax implications on boat slip fees?
Well, the boat slip fees are taxable if it's not part of your quarterly assessment. And most of the boat slips are owned in effect or leased from the association. So that's why it's not, once it doesn't become an assessment amount and it's something that you're paying that other people don't have to pay, that makes it taxable.
Okay, very good. And what happens if your management company is late getting your budget prepared on time? What can you do?
Yeah, that's a question that puts me in the hot seat. There's obviously the timing for it, and you should look to that. I mean, this year, I think with the storms that we've had and the like, I know on the tax side, things have been extended. And I know that with the Sears reporting that's coming in as well, that's going to hold people up too. So I think that once again, you probably need to reach out and see what notices have gone out. The IRS in the state of Florida have put out notices extending the times to file the returns. I know that the payroll tax returns have been extended for all the counties that have been affected. And my suggestion would be, if you know you're going to be late, then at this point, just see what types of extensions. Maybe go out to the DBPR website and see what, if anything, they've done.
All right, and then we've got just a couple questions as we're closing in on the top of the hour. Let's see. What is the recommended fund balance to keep on hand? Would that be 2 months of expenses? What do you recommend for?
From a cash flow, yeah, from a cash flow standpoint, 2 to 3 months would be perfect.
Wonderful.
It's gonna give you that opportunity to have that cash. So, for example, if you had something that was a yearly insurance premium, you'd have that extra amount of funds in there to pay rather than going out and financing it.
All right, very good. And then one last one before we close. Do reserve funds count towards owner's equity?
Yes, they do. And that's going to be my next, I think, seminar is going to be talking about that, because typically when you make contributions to reserves and or capital project funds, it goes to increase your basis in the property, which is really important. And I'm giving away too much information for my next presentation.
All right. Well, thank you, everybody. We want to be mindful of everybody's time. Thank you so much for joining. We are so sorry about the audio difficulties. You will receive the presentation and the audio and contact details. We're sorry we didn't get to all the questions, but please feel free to email them. Our next webinar in this series is November 13th at noon, and it talks about association resort style amenities. So if you live in an association that has things like a cafe and a theater and boat slips or any of those types of really nice amenities, this is going to be a great webinar for you. And then our last one is December 11th at noon, and it talks about homestead exemptions as well as the basis of your property and how these association improvements are impacting the basis of your property, which will be important to you when it's time to sell. So thank you so much, everybody. We really appreciate it, and we look forward to seeing you again on a future webinar.
Thanks for watching. For more great educational content, click the subscribe button now.